Hello, I'm John A.G. And if you felt that sinking feeling in your stomach last week when gold and silver collapsed, if you questioned whether you had misunderstood this market entirely, I want you to slow down for a moment and listen carefully, because something important has just happened that most people are completely misreading. I'm recording this now because over the past 24 hours, the precious metals market has delivered one of the sharpest psychological reversals we've seen in decades, and the institutions that usually stay silent during moments like this are now speaking clearly. Gold surged more than 6% in a single session. Silver rebounded violently, climbing over 12% from the lows. Mining stocks across global markets are ripping higher, and behind the scenes, the largest financial institutions in the world are confirming what this move actually means. The panic selling did not change the story. The investment case did not break. And the people who truly matter in this market did not abandon their positions. That last point is the one you need to internalize because it runs directly against the fear narrative that dominated headlines only days ago. Deutsche Bank, one of the most influential financial institutions on the planet, has now stated openly that investor intentions in precious metals across official, institutional, and individual participants have not likely shifted for the worse. That is not speculation. That is not commentary from a retail trader. That is the establishment acknowledging that the sell-off was an overreaction. When language like that comes from inside the system, it deserves your full attention. What we witnessed last week was not the end of a rally. It was a stress test of conviction. Gold fell nearly 10% in a single session. Silver collapsed more than 30%, marking its worst one-day performance since 1980. The speed of the move created a sense of finality, as if something had fundamentally snapped. People sold not because they had reevaluated the long-term picture, but because they could not tolerate the velocity of the decline. Margin calls cascaded. Stops were triggered. Leveraged positions were forced out at any price. And in moments like that, markets do what they always do. They overshoot reality. Almost immediately after that liquidation wave burned itself out, prices reversed. Spot gold surged toward $4,900 per ounce. Gold futures in New York climbed above $4,930. Spot silver rebounded sharply, settling near $87 per ounce, while futures posted gains exceeding 12%. These are not routine moves. They are violent corrections to an equally violent dislocation, and they tell us something essential about what actually caused the crash. Markets do not move in straight lines. They move in waves, shaped by human behavior, leverage, and liquidity. They exaggerate both optimism and fear. When positioning becomes crowded, even a modest catalyst can trigger a chain reaction. In this case, several forces converged at once. The US dollar rebounded. Expectations shifted following President Trump's nomination of Kevin Warsh as the next Federal Reserve Chair. Traders reduced exposure ahead of the weekend. The CME raised margin requirements. None of these factors taken alone justified a collapse of that magnitude. Together, they created the conditions for forced selling. This is exactly the point Deutsche Bank made in its analysis. Their strategists stated that the adjustment in precious metal prices overshot the significance of its apparent catalysts. In plain terms, the market fell far more than the underlying reasons could justify. That distinction matters because it separates technical events from fundamental ones. A fundamental breakdown changes the trajectory of a market. A technical liquidation creates opportunity. Once prices were pushed well below levels that reflected genuine supply and demand, buyers stepped in. Not emotional buyers, not momentum chasers, sophisticated capital that understands value under stress. What followed was not a random bounce, it was a recalibration. The reaction was not limited to futures markets. It rippled across the entire precious metals ecosystem. In Europe, the Stoxx 600 Basic Resources Index jumped more than 2% as mining shares surged. London-listed giants moved decisively higher. Rio Tinto gained over 2%. Anglo-American rallied nearly 4%. Antofagasta climbed more than 3%. Fresnillo, the world's leading primary silver producer and one of the strongest performing stocks on the FTSE 100 this year, advanced over 4% in a single session. That is not speculative noise. That is capital moving deliberately toward assets tied to long-term metal demand. In the United States, the response was even more pronounced. Leveraged silver exchange-traded products jumped into double-digit gains before the opening bell. Physical silver funds posted strong advances. Mining equities exploded higher across the board. Endeavor Silver surged more than 9%. Kerr Mining gained over 9%. Hecla Mining and First Majestic Silver both climbed more than 8%. These moves were broad-based, synchronized, and aggressive. They reflect recognition that the sell-off created mispricing, not resolution. This institutional response is critical because it reveals how professional investors interpreted the crash. They did not see a failed thesis. They saw a liquidity event. Barclays echoed this view. noting that while positioning had become stretched and technical conditions overheated, the underlying bid for gold remained resilient amid geopolitical uncertainty, policy ambiguity, and reserve diversification trends. That phrase, underlying bid, is important. It refers to persistent demand that does not disappear because of short-term volatility. Central banks continue to accumulate. Institutions continue to allocate. Individuals continue to seek protection. JP Morgan went further. Their analysts reiterated expectations that gold could reach $6,300 per ounce by the end of 2026, representing roughly a 30% gain from current levels. They described gold as a dynamic, multifaceted portfolio hedge and emphasized that investor demand has exceeded their previous forecasts. When institutions with direct visibility into global capital flows tell you demand is stronger than expected, it should recalibrate how you interpret short-term price action. Silver's story is even more volatile, and for good reason. Silver fell harder than gold because it is a thinner market with heavier retail participation. It reacts more violently to sentiment shifts, but that same structure also fuels explosive recoveries. Analysts have acknowledged that speculative positioning amplified the short-term move, yet they also caution against attributing the entire episode to speculation alone. Silver is not just a monetary metal, it is an industrial necessity. Demand tied to data centers, artificial intelligence infrastructure, and renewable energy continues to accelerate. Research published earlier this year projects that global silver demand will reach between 48,000 and 54,000 metric tons annually by 2030. Supply, however, is expected to rise only to approximately 34,000 tons. That gap is structural. Even at the high end, production would meet only about 70% of projected demand. At the low end, closer to 60%. The solar sector alone is projected to consume between 10,000 and 14,000 tons of silver annually by the end of the decade. That could represent more than 40% of total global supply allocated to a single industry. When one sector absorbs that much material, it leaves less available for electronics, medical applications, investment demand, and monetary reserves. This imbalance is not theoretical. It is already forming. Silver has always behaved this way during strong phases. It runs ahead of itself, corrects sharply, and then resumes its advance as underlying demand asserts itself. What matters is not the short-term swing, but the direction of the forces beneath it. Those forces are pointing higher. This brings us to a deeper question. Why are gold and silver attracting such sustained interest at all? Surface explanations focus on tariffs, Federal Reserve uncertainty, and geopolitical tension. Those factors matter, but they are not the foundation. The foundation lies in the structure of the financial system itself. Gold occupies a unique position because it carries no counterparty risk. Every other financial asset depends on someone else fulfilling a promise. Bonds rely on issuers, stocks rely on corporate performance, bank deposits rely on institutional solvency, currencies rely on central bank credibility. Gold relies on none of these. It does not promise yield. It does not depend on policy. It simply exists. In a world saturated with credit risk, that quality becomes invaluable. Public and private debt levels have reached historic extremes. The United States national debt now exceeds $38 trillion and continues to grow. Interest costs consume an increasing share of fiscal resources. Governments facing these realities have limited options. History shows they rarely choose default or austerity. They choose currency debasement. Over time, purchasing power erodes. Gold's role has always been to preserve value when paper systems strain. From the beginning of President Trump's current term through early 2026, gold prices nearly doubled. Silver rose almost fourfold. Those are not ordinary market moves. They are signals of shifting confidence, and they set the stage for what comes next. The question now is not whether volatility will continue. It will. The question is whether the structural buyers have changed their stance. Deutsche Bank says they have not. That distinction separates panic from opportunity. Understanding whether this rally continues requires separating emotion from evidence because markets like this are designed to confuse people at exactly the wrong moment. After a violent sell-off, the instinct is to assume something broke. But history shows that the most damaging mistakes are made when investors confuse price action with fundamentals. Mark Matthews, head of Asia Research at Bank Julius Baer, framed this distinction clearly. He noted that once investors regain confidence that prices have stabilized, purchases of gold and silver typically resume, not because conditions improved, but because the original reasons for owning these assets never disappeared. Those reasons remain intact today. The US dollar continues to face structural pressure. Central banks remain net buyers of gold, and global uncertainty has not resolved itself. Matthews emphasized that while future gains may be less vertical than the previous surge, a slower ascent is actually healthier. Parabolic moves attract fragile positioning. Steady trends attract durable capital. Markets built on durable capital last longer. Deutsche Bank echoed this interpretation. Their analysts stated that gold's thematic drivers remain positive and that investor rationale for holding precious metals has not changed. They went further, noting that current conditions differ materially from prior periods of sustained weakness, such as the early 1980s or the correction in 2013. In those cycles, rising real rates, improving fiscal discipline, and declining debt burdens created headwinds for gold. Today, none of those conditions exist. To understand why last week's crash unfolded the way it did, it's important to examine the narrative surrounding Federal Reserve leadership. President Trump's nomination of Kevin Warsh as the next Fed chair was widely cited as a catalyst. Warsh is perceived as a conventional figure, associated with policy continuity rather than radical shifts. Some market participants interpreted this as supportive of a stronger dollar and more predictable monetary policy, which can temporarily pressure precious metals. However, attributing a 30% collapse in silver to a personnel nomination stretches credibility. Matthews offered an alternative explanation that aligns better with market mechanics. Precious metals prices had already accelerated rapidly in the preceding weeks. Gains had become vertical. Once profit-taking began, it cascaded. Selling fed on itself. Liquidity thinned. Stops triggered. This is how parabolic moves unwind, not through gradual digestion, but through sudden air pockets. The subsequent rebound reinforces that interpretation. If fundamentals had deteriorated, prices would have struggled to recover. Instead, they snapped back with force. That tells us the selling pressure was exhausted, not validated. Central bank behavior adds another layer of context. Over the past several years, central banks in emerging economies have steadily increased gold reserves. China, Turkey, and others have been consistent buyers, seeking to reduce reliance on the US dollar and diversify reserve assets. These purchases are not speculative. They are strategic. Central banks do not trade short-term volatility. They accumulate over years. This matters because it creates a price floor. When prices fall sharply, central banks do not panic. They evaluate value. Lower prices often represent opportunity, not danger. During last week's sell-off, while retail traders were liquidating positions, structural buyers were likely absorbing supply quietly. Silver does not benefit from the same level of central bank participation, but it carries a different kind of structural support. Its industrial demand profile makes it uniquely sensitive to long-term technological trends. Artificial intelligence, data center expansion, electric vehicles, and renewable energy all require silver. Unlike gold, which can be recycled endlessly without loss of function, silver is often consumed in industrial processes and lost to recycling inefficiencies. The projected supply deficit is therefore critical. Demand forecasts calling for up to 54,000 tons annually by 2030 are not speculative projections. They are grounded in known infrastructure plans and technology adoption curves. Supply, constrained by geology and capital investment cycles, cannot respond quickly. Mines take years to develop. Production growth is slow. When demand persistently exceeds supply, price volatility increases, corrections become sharper, rallies become more explosive. This is not instability, it is tension. Silver's reputation as the most volatile major asset is well earned. It is sometimes called the devil's metal because it punishes emotional traders. It rises faster than gold during bull phases and falls harder during corrections. That behavior drives people out at exactly the wrong time, but volatility does not invalidate the thesis. It expresses it. Gold's appeal, by contrast, is rooted in its simplicity. It carries no counterparty risk. It does not depend on economic growth. It does not promise yield. In an era where nearly every financial instrument embeds layers of credit exposure, gold's independence is its value. Diego Fernandez, head of portfolio strategy at a European investment firm, articulated this clearly when he observed that in a world where almost every financial activity incorporates credit risk, gold remains the only asset that makes no promises. It pays no interest. It relies on no institution. It simply exists. That absence of obligation is precisely what gives it power during periods of systemic stress. Debt levels amplify this dynamic. The United States now carries more than $38 trillion in federal debt. Interest payments consume a growing share of fiscal resources. Similar patterns exist globally. Governments confronted with these realities face limited options. Historically, they avoid default. They resist austerity. They opt for monetary accommodation. Over time, this erodes purchasing power. Gold does not prevent this process. It reflects it. It absorbs the consequences of policy choices. That is why its price trends over decades matter more than its movements over days. Between the beginning of President Trump's current term and early 2026, gold nearly doubled in price. Silver rose close to 4 times. These gains occurred alongside rising debt, expanding deficits, and increasing policy uncertainty. They were not accidents. The question investors must ask now is whether those drivers have reversed. There is no evidence they have. Debt continues to grow. Central banks continue to diversify reserves. Industrial demand for silver continues to expand. Geopolitical risk remains elevated. Volatility will persist. Sharp pullbacks will happen again. They are not signs of failure. They are part of the structure of these markets. What matters is positioning. Holding too much leverage invites forced liquidation. Holding a position too large relative to one's tolerance invites panic. Precious metals reward patience, not precision. They punish emotional timing. For investors already holding gold and silver, the lesson from last week is not to chase price action. It is to assess whether the original reasons for holding still apply. If they do, short-term volatility should not dictate long-term decisions. For those considering entry, the recent correction removed some speculative excess. Prices remain below recent highs. Institutional analysts continue to validate the thesis. But discipline matters. Position sizing matters. Time horizon matters. There's no universal allocation that fits everyone. Risk tolerance differs. Financial circumstances differ. What matters is constructing a position that allows one to endure volatility without being forced into decisions at the worst possible moment. Looking forward, several indicators will help clarify direction. Price stability after the rebound matters more than the rebound itself. Sustained weakness in the dollar would support metals. Continued central bank accumulation reinforces the long-term case. Developments around Federal Reserve leadership will shape expectations. Industrial demand data for silver will signal supply stress. Mining stocks outperforming metals often precede further gains. These are not predictions. They are reference points. Zooming out, the broader picture becomes clearer. Global financial markets are navigating a period of transition. Old assumptions are being challenged. Policy tools are stretched. Investors are searching for assets that do not depend on trust in complex systems. Gold and silver occupy that role not because they are perfect, but because they are independent. They do not eliminate risk. They reframe it. That independence comes with volatility. It comes with discomfort. It requires conviction. But over long cycles, it has preserved value when paper systems faltered. The people who suffer most in markets like this are those who react emotionally to price moves without revisiting fundamentals. They sell after declines and buy after rallies. They confuse noise with signal. The people who benefit are those who understand the structure, size positions appropriately, and allow time to work in their favor. Last week's sell-off did not rewrite the story. It revealed it. At this point, it's worth stepping back and looking at how investors typically misinterpret moments like this, because the danger is not the volatility itself, but the conclusions people draw from it. When prices fall sharply, the instinct is to search for a dramatic explanation, some hidden shift that suddenly invalidates everything that came before. In reality, markets often move violently precisely because nothing fundamental has changed. They move to test resolve, to transfer assets from weak hands to strong ones, and to reset positioning before the next phase begins. Deutsche Bank's statement cuts directly through the noise. When they say that investor intentions in precious metals have not likely changed for the worse, they are making a claim about behavior, not sentiment. Sentiment can flip overnight. Intentions, especially among institutions and official buyers, move slowly. That distinction is crucial. Retail panic can move prices temporarily, but long-term trends are shaped by capital that operates on multi-year horizons. This is why comparing today's environment to past gold downturns is misleading. In the early 1980s, gold faced rising real interest rates, tightening monetary policy, and declining inflation. In 2013, the market was adjusting to the prospect of sustained quantitative tightening and reduced central bank intervention. Today's landscape is fundamentally different. Debt levels are higher. Fiscal pressures are more severe. Monetary policy flexibility is constrained. Structural demand for hard assets is stronger. JP Morgan's projection of $6,300 gold by the end of 2026 should be viewed in that context. It is not a prediction of a straight-line move. It is an acknowledgement that the forces pushing gold higher remain active. Even if prices fluctuate sharply along the way, the destination implied by those forces has not shifted. Silver amplifies this dynamic because it sits at the intersection of monetary demand and industrial necessity. Its volatility reflects that dual role. When confidence rises, it surges. When fear hits, it collapses. But unlike purely financial assets, silver cannot be conjured into existence by policy decisions. Its supply is bounded by physical constraints. The projected gap between silver supply and demand is not a future problem. It is already emerging. Production growth has lagged demand growth for years. New mining projects face rising costs, regulatory hurdles, and long development timelines. Meanwhile, demand tied to solar power, electric vehicles, and data infrastructure continues to expand. This creates a market that is inherently unstable in price but stable in direction. This instability is often misread as risk rather than signal. Volatility is uncomfortable, but it is not the same as uncertainty. In many cases, it is the market's way of adjusting to pressures that cannot be resolved smoothly. Gold's role in this environment is different but complementary. It functions as a reference point for trust. When confidence in institutions erodes, gold benefits not because it promises returns, but because it promises nothing. It does not default. It does not dilute. It does not require belief in policy competence. It simply exists as a store of value outside the financial system. This quality becomes increasingly important as global debt levels rise. With the U.S. national debt exceeding $38 trillion and interest costs climbing, fiscal flexibility is narrowing. Similar patterns are visible across developed economies. Governments can manage these pressures temporarily, but they cannot eliminate them without significant trade-offs. History shows that prolonged debt burdens tend to be resolved through currency debasement rather than outright default. Inflation, whether gradual or sudden, becomes the release valve. Gold and silver do not prevent this process, but they reflect it. Their rising prices are not anomalies. They are indicators. The rapid gains in gold and silver over the past several years should be viewed through that lens. They are not speculative excesses, divorced from reality. They are responses to structural imbalances that continue to grow. This does not mean prices cannot fall sharply again. They can. They will. Anyone involved in precious metals must accept that reality. The question is not whether volatility exists, but whether one is prepared for it. The investors who struggle most in these markets are those who approach them with short-term expectations. They enter positions expecting smooth appreciation. When volatility appears, they interpret it as failure. They sell at the wrong time and re-enter at higher prices, repeating the cycle. The investors who succeed approach precious metals differently. They treat them as long-term allocations rather than trades. They size positions conservatively. They expect volatility. They measure success over years, not weeks. This mindset does not eliminate stress, but it reduces the likelihood of catastrophic decisions. Position sizing is central to this. Holding too large a position relative to one's tolerance invites emotional responses. Holding a position that feels manageable allows one to think clearly during drawdowns. There is no universal rule for allocation. What matters is alignment between position size, time horizon, and psychological comfort. The events of last week offer a clear lesson. Those who sold into the panic locked in losses and surrendered their positions to buyers who understood the structure of the move. Those who held through the volatility retained exposure. Those who added selectively benefited from the rebound. Markets do not reward comfort, they reward discipline. Looking ahead, several developments will continue to shape the precious metals landscape. Dollar movements will influence short-term pricing. Central bank activity will underpin long-term demand. Industrial consumption trends will drive silver's supply dynamics. Policy signals from the Federal Reserve will affect expectations. Mining equity performance will offer clues about institutional positioning. None of these factors operate in isolation. They interact in complex ways. That complexity is why simple narratives fail. The broader takeaway is this. The sell-off was violent, but it did not invalidate the underlying case for gold and silver. The rebound was equally violent, but it does not guarantee immediate continuation. What it does confirm is that structural buyers remain engaged. Deutsche Bank's observation about investor intentions is the anchor point. When the entities that allocate capital on a global scale maintain their positions, short-term price movements become less meaningful. This does not imply certainty. Markets are probabilistic, not deterministic. Outcomes vary. But probabilities are shaped by structure, not headlines. We are operating in a financial environment characterized by elevated debt, constrained policy options, geopolitical tension, and technological transformation. These conditions favor assets that are independent of credit systems and industrial inputs that cannot be easily substituted. Gold and silver occupy that space imperfectly, but uniquely. The discomfort associated with holding them is part of the cost. Volatility is the price paid for independence. Those unwilling to pay it should avoid these markets. Those who accept it should do so with eyes open and expectations calibrated. The most damaging behavior is not holding through volatility. It is reacting emotionally without reassessing fundamentals. Fear-driven decisions feel urgent, but are rarely optimal. The institutions guiding this market understand that distinction. They operate on frameworks, not impulses. When they say the investment case remains intact, they are not expressing optimism. They are stating assessment. The temporary panic does not define the trend. The behavior of structural buyers does. That is the framework worth remembering the next time prices swing violently. Ask whether the forces driving long-term demand have changed. Ask whether supply constraints have eased. Ask whether debt dynamics have reversed. If the answers are no, then volatility is information, not instruction. Markets like this test patience. They reward preparation. They punish complacency. Gold and silver are not vehicles for quick certainty. They are instruments for navigating uncertainty over time. That distinction matters. The recent sell-off stripped away leverage, excess, and fragile positioning. What remains is a market grounded in fundamentals that have not disappeared. Where prices go next will depend on how those fundamentals interact with policy, currency movements, and investor behavior. No one can forecast that path precisely, but the direction of pressure remains visible. For those positioned appropriately, with realistic expectations and sufficient patience, the environment remains constructive. For those reacting to every swing, it remains hazardous. The choice lies not in the market, but in approach. The metals did not fail last week. They did what they have always done. They tested conviction, exposed leverage, and reminded participants that value and price are not the same thing. That lesson is uncomfortable, but it is also clarifying. And in markets like this, clarity is an asset.